Welcome back to the channel, everyone. Good news, the tree work is finished and there should be no more weird noises. Today I want to talk about how Robinhood are literally desperate for new customers. So desperate, in fact, they're literally giving away free money. So stay tuned and let's make some money. But before I dive into the video, I just want to give a massive shout out to everyone that's part of the team on the private Discord. There we talk about AMC, crypto and other stocks as well, sharing due diligence, news stories and other updates. And they're all in with the chance of winning $600, which I'm drawing the winner from everyone in the Discord on the 28th of August. So if you want to have the chance of winning $600, all you've got to do is join the private Discord, linked in the description below. And now I want to dive straight in with the key information. So, Robinhood is giving away $100,000 to recruit new investors. Robinhood, which reported a $501.7 million loss, or $2.16 loss per share on Wednesday for the second quarter, is giving away $500 to 200 users who join or refer friends to the site. Those who join by Monday must be approved by the company and link their bank account to the site by August 27th. The company said it will notify the 200 winners by September the 16th by email. The prize cannot be claimed for 30 days. The company has previously enticed new traders to join by giving away a share of stock of various other publicly traded companies. Critics contend Robinhood and say that the site engages in gamification, using bright colours and congratulatory messages that can encourage impulsive and emotional investing behaviour. Robinhood, which became a publicly traded company on July 29th, has altered some of its prior practices that drew criticism, and it does not allow minors to trade as all of its investors must be 18 years old. The company this summer was fined $70 million over outages and misleading and exposing customers to risky trading tools. The firm approved thousands of customers for options trading, but those customers did not satisfy the firm's eligibility criteria, according to federal regulators. Robinhood, in an SEC filing prior to its initial public offering, said it had settled a wrongful death suit after Alex Kearns, a 20-year-old customer, died by this word after believing he lost a significant amount of money by trading in options on the investing platform. So why does this article mean that Robinhood is desperate for new users? Well, obviously, Robinhood raked in a massive loss in the last quarter of $501 million, but they did actually report an increase in revenue. That increase in revenue effectively stemmed from all the new customers that joined their platform in quarter one and quarter two, as meme stocks and crypto were booming. However, in quarter three, everybody has now realised how shady payment for order flow is and how shady Robinhood is as a broker, and has pulled their money out of Robinhood and no longer uses that platform and uses Fidelity instead. This is actually something I've been recommending that you do for weeks and months now, to withdraw your money out of platforms like Robinhood or Webull that do use payment for order flow, and to put your money in firms like Fidelity that don't. Effectively, firms that accept payment for order flow, like Robinhood, sell their order flow to market makers like Citadel, who just put those orders through the dark pool, and therefore those orders don't impact on the lit exchange price of AMC. And now with tons and tons of customers pulling their money out of Robinhood, it means that Robinhood's revenue is going to go down. They aren't going to be able to sell as much order flow and therefore aren't going to receive as much revenue. Considering their general expenses is probably going to remain the same, if not increase, as they've probably taken on new people, like hired new people to deal with the increased traffic and upgraded their systems to deal with that increased traffic. It means they're going to be spending more on costs but receiving less revenue. Therefore, next quarter, in quarter three, I wouldn't be surprised to see this loss of $501 million get even bigger and have an even worse result. Therefore, Robinhood are literally having to resort to giving away free money just to get some new customers on their platform and get some new deposits, and therefore generate some more revenue. I do think this is very bottom of the barrel stuff. They already give away free shares when you sign up and deposit, and now they're trying to increase the amount of sign-ups and make it even more appealing by doing a large giveaway and literally giving away free money. However, even though you're in with a chance of winning $500, I don't really recommend signing up for Robinhood if you haven't already, just because it's a very shady platform and they do sell that order flow. It'd be much better to stay with Fidelity, because that way there's an increased chance of the moass happening. If everybody suddenly left Fidelity all at the same time, all over again, and went back to Robinhood, That means that all of our orders would be going straight through the dark pool, and they could use so many more shares to continue crushing the AMC price, which would not be good for the squeeze. Speaking of which, I briefly wanted to touch on how the squeeze actually works and why some people don't believe AMC can go to 800k, and why this poster here is going to explain why it can. Supply and demand move stocks. As people buy, the price goes up, or if there's more buyers than sellers, the price goes up. As people sell or short, the price goes down, or if there's more shorters or more sellers than there are buyers, the price goes down. That's a fairly simple supply and demand equation. As more people want something and are prepared to pay more for it, the price goes up. But as more people are selling something and are prepared to receive less money, the price goes down. In a short squeeze scenario, the shorts are demanding a lot of shares in one go because they're being forced to cover as they're being liquidated, and therefore are buying up all the shares, and therefore the buying pressure is massive. The issue for them is if there isn't a lot of supply, as in people selling. If there's not many sellers but lots of buyers, obviously the price is going to go up. The price just keeps on rising until the demand can be matched with enough sellers. As a possibility, we know we own more than the entire float of shares because of all the synthetics. This means that they may only be able to close out their short positions if we sell. Think about that. They literally should not be able to buy without us selling. They will have to buy our shares at whatever price we give them. And not only that, but they'll have to buy back all of the synthetic shares first and cancel those synthetic shares and then buy back the real shares as well to cover their short positions. As they can't cover synthetic shorts, or they can't cover real shorts with synthetic shares, they can only cover synthetic shorts with synthetic shares. So if no one sells at 10k, it will therefore rip past 10k until a lot of people sell. If things went perfectly, this scenario would play out. Margin call happens, AMC stock rises rapidly, people don't sell, the price goes past 10k, 100k, 200, 300, 400, 500, 600, 700, and to 800k. And then at which point at 800k, people start selling. Then it will go in the opposite direction as there's more sellers than there will be buyers, and therefore the stock will then fall rapidly after hitting 800k. It will go 800k, 700k, 600k, and so on. Now, on top of this, there should also be volatility halts, unless they change the rules in a squeeze scenario, and maybe it squeezes pre-market, for example. So the price will stop moving for 10 minutes before ripping or before tanking again. Now, something you have to remember is that not every single shareholder is going to sell at 800k a share. There are going to be many people that pay per hand before that. Let's say $300 or $1,000 or $5,000, or maybe higher or maybe lower. It's just inevitable. I can't speak for all 4.1 million plus apes all at the same time. And I also can't speak for those institutions and just those other regular investors that aren't apes. Therefore, if too many people do sell and pay per hand early, then obviously the price won't necessarily reach 800k. It will just reach a much higher value than it currently is, but lower than 800k. This is why so many people are trying to raise awareness of AMC and ensure that people don't pay per hand too early and realise the magnitude of this event and the possibilities of this event. Speaking of which, another poster posted this chart indicating that the early morning short ladder attack failed today, and that's why AMC is running up so nicely. At the time of making this video, AMC is up around 9.5% and has just passed the $37.50 mark and is making its way back to $38, $39 and potentially $40 as well. I personally think this is a very good start to the week, and we're now heading back to that $40 barrier and that $40 resistance. If we can break through that $40 resistance, I think we'll see some very promising price action. And finally, this post wants to talk about the bull thesis for AMC and why we're going up in the short term, the medium term, and the long term. Let's start with the wider markets. Before we talk about AMC, we need to talk about the outlook on the wider markets. And this is something I've mentioned in my previous videos as well. I can be brief here, but it's still important to know, as you need to know and understand the environment from which these stocks will grow. Short-term wider markets. It's looking bleak for the economy, but that's good for AMC. We've got a lot of macro indicators like the reverse repos, the Schiller ratio, CPI, PPI, all pointing towards an upcoming market crash. As counterintuitive as this sounds, a market crash is good for heavily shorted stocks, provided the holder of these stocks, well, holds on for dear life. Basically, you've got to have diamond hands. Medium term, neutral for the economy, good for AMC. We still have the pandemic to contend with, which will slow down any form of recovery, but at the same time, industries have grown and learned to adapt and live with the pandemic. Overall, this will keep us in a natural range or a neutral range, meaning in the medium term, AMC will make their own fate. And for the long term, it's bullish overall. Markets always recover, and if AMC has taken proper advantage of the short and medium term, then going into the long term, they could be poised to become even bigger. Lots of companies have survived crashes and then thrive in the aftermath due to reduced competition and healthy balance sheets, which we know for sure that AMC has, with over $2 billion of cash on hand to be acquisitive for any companies that do fail in an eventual market crash. Now let's look at the AMC fundamentals, the profitability and earnings. So currently AMC's earnings are negative, meaning they're spending more money than they're making. That being said, it's not all doom and gloom on this front. Quite the opposite. AMC beat the last estimated earnings, and its earnings have been continually trending to a positive, with the executives at the company projecting that they will be profitable again come Q4 of 2021 this year, which is massive. At the end of the day, you can't go bankrupt if you're making money. Even if debt comes up to be paid and AMC doesn't have the cash on hand to pay it, it does, more on that in a second, no lender in their right mind would take a profitable company to bankruptcy court. Alternatively, AMC could just refinance their debt to a different lender, and obviously a different lender would refinance that debt because AMC would be profitable and would be able to pay it back in the future. They'd shut down the company and lose out on potential returns. Even taking away executives' estimates, financial analysts are looking at AMC being profitable around Q3 of 2022, with them being damn near break even in Q1 and Q2 of 2022 as well. Therefore, let's look at it on a short-term timescale. The short squeeze, the big one. Currently, AMC has reported short interest of 85 million shares, or 17% of its free float. We know this number is rubbish and likely a lot higher, but between the strong fundamentals and a market crash threatening it, makes the chance of a short squeeze, even with just 85 million shares, a potential guarantee. Hidden short interest, whether that be via abusive options use, synthetic long puts or married puts, or via transference to ETFs, we know a vast majority of the short interest in AMC has been hidden. That effectively changes a short squeeze into a mother of all short squeezes. Abnormal options. Love them or hate them, condone or condemn them, you can't deny there is a treasure trove of data to be pulled from options. In particular, they point to resetting failed to delivers and hiding short interest. There's also the gamma squeeze aspect to consider, and another strong avenue for a price rise. FTDs. AMC has abnormally large amounts of FTDs and has even found itself on the threshold list this year. Given enough time on this list, it can cause a cascade of forced covering, leading to another avenue for a price increase. Conclusion, moass is coming. Now I'll leave the rest of this article down in the description below in case you want to read the medium term and the long term aspects for yourself. Guys, be sure to let me know down in the comments below what you think about Robinhood being desperate to get new customers in any way they can. And also, if you haven't yet signed up to a trading platform, then be sure to check out the links down in the description below to Moomoo if you're in the US or in Singapore, and Free Trade if you're in the UK to get some free shares. And as always guys, if you enjoyed this video, be sure to check out some of my others. Alternatively, subscribe to the channel and ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.